Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at the metals company.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. For you, the listener, who is trying to gain an edge in this market, the metals company presents one of the most intellectually challenging cases we've done recently.
It really is.
We are seeing a company with a market narrative that is so completely bifurcated. It feels like we're analyzing two different businesses under just one ticker.
Exactly. It's simultaneously presenting a story of explosive high-margin growth.
And on the other hand, a story of disappointing stagnation.
That duality is really the key to understanding what's going on with the stock. So let's unpack this tale of two Q1s. The aggressive bullish thesis focuses entirely on their lithium division.
And when you isolate that one segment, the numbers are, well, they're truly incredible.
Absolutely. The data we have for the lithium division, just for Q1 2025, showed $142.7 million in revenue.
Which is a powerful 38% year-over-year increase.
A huge jump. That kind of growth has completely reshaped the company's financial profile.
It's shifted the whole identity of the business. I mean, we are looking at a lithium division that now accounts for a massive 78% of the company's total revenue.
78%. It signals a rapid transition away from that legacy industrial side.
And here's where the bulls get really excited. The margin expansion.
Right.
Gross margins just within that lithium segment. They soared from 42.1% all the way up to an industry-leading 51.2%.
In just the first quarter.
Exactly. This performance was so strong that management felt comfortable enough to revise its full-year 2025 revenue guidance upwards. They're now targeting somewhere between $625 and $650 million.
So if you only look at that lithium story, this looks like a clear, high-growth, technology-driven leader. Simple as that.
But that only tells half the story, and this is where the caution flag goes up for anyone looking at the overall financial picture.
Okay, so what did the full picture look like?
When the total official Q1 earnings were released, the company reported $187.2 million in overall revenue.
Which actually missed the street's consensus expectation. That was $189.1 million, and the EPS fell short too.
So you have this fascinating structural problem where, explosive growth in the key future asset is being dampened by significant underperformance in the legacy business.
Management was quick to attribute that softness to their older industrial metals segments, right?
They were. These are the operations dealing with standard lower margin products, basic copper and aluminum components.
So the lithium part grew like crazy, but the company still missed total revenue expectations because the legacy division essentially shrank.
Precisely. And the impact goes beyond just the top line. While the overall guidance was reiterated at a massive higher range, $760 to $780 million for the full year.
That guidance came coupled with stubbornly flat EBITDA margins. They're projected to remain at just 8 to 9%.
Now, that is a critical piece of information that you really need to unpack.
It is. If their largest revenue driver, the lithium business, is running at a gross margin north of 51%, why is the total EBITDA margin stuck below 10%?
It suggests severe margin compression and, frankly, inefficiency in those older industrial areas.
The competition.
The high-volume, low-margin products they sell are facing intense competition, particularly from players like RPM Metals and Alumex, who are reportedly gaining crucial market share.
So the legacy business is struggling just to stay profitable.
It seems like it. It's forcing the lithium profits to subsidize the older operations, and that's what's dragging down the overall profitability. That margin discrepancy confirms the two realities living inside one company.
That leads us perfectly into the advantage that anchors the entire bullish case, the technology.
Yes. The entire long-term valuation hinges on their proprietary direct lithium extraction, or DLE technology, being deployed at their Manitoba project.
And this isn't just a small improvement over existing methods. We're talking a foundational shift.
For sure. The DLE technology is reported to achieve a 92% lithium recovery rate.
To put that in context for you, that is essentially the highest recovery rate in the industry.
But the true game changer is the environmental advantage.
Which is increasingly important for any company trying to get permitting and, institutional capital.
Exactly. This tech uses 80% less water than traditional brine methods, and crucially, It completely eliminates the environmental liability of evaporation ponds.
Getting rid of those ponds is a massive win for PR, for permitting, for just overall efficiency.
And they've spent years protecting this. We've confirmed they hold 7 issued U.S. patents on the core process.
That's why the bulls argue for a pretty significant competitive lead, maybe 5 to 7 years.
Right. Competitors are still trying to prove DLE at the pilot or lab scale, while the metals company is moving toward commercialization.
And this tech success has translated directly into massive revenue visibility. The bullish thesis proudly points to extensive offtake agreements already secured.
We're talking about deals with Tier 1 EV battery makers LG Energy Solution, SK On, even Stellantis through a JV with Tesla.
And that represents 89% of their projected 2026 capacity. In theory, that should totally de-risk the future revenue stream.
Incredible security for a resource company. But here is the massive narrative contradiction that makes this stock so volatile.
The 10K.
Exactly. We have these massive offtake agreements reported publicly driving the valuation. Yet when you look at the company's own official filing, their 10K, it explicitly states that no lithium or battery material initiatives are currently underway.
I have to pause on that because this is where critical thinking is so essential for you as an investor. You have to ask, why would management allow this gap?
I mean, the market is pricing the stock based on these forward-looking contracts for a product line that the company's most stringent legal document says isn't even active yet.
That is an informational gap the size of the Atlantic Ocean. Is it just a timing issue, or are the offtake commitments maybe less ironclad than the press releases suggest?
It raises a huge question mark over the enforceability and the start date of that 89% capacity commitment.
Regardless of that operational confusion, though, the balance sheet indicators do look robust.
They do, which supports the credibility of their transition strategy. They ended Q1 2025 with $318 million in cash, a significant jump from year-end 2024.
And a major contributor to that cash cushion was the non-dilutive grant they got.
The $85 million grant from the U.S. Department of Energy. And this is where we have to provide some context for you.
Yeah, this isn't just cash. It's a massive vote of confidence tied to the IRA, the Inflation Reduction Act. This is government support aimed specifically at shoring up domestic supply chains for critical minerals.
That DOE endorsement is transformative. Plus, their net debt to EBITDA ratio is exceptionally strong at 0.7x. That gives them immense flexibility.
And here's a major turning point in their financial health. Free cash flow turned positive in Q1.
Registering $44.2 million. Positive SCF is often the green light for strategic moves like buybacks or accelerating expansion.
And the stock's momentum is confirming this underlying financial confidence. Looking at the charts, the stock recently broke decisively above the $14.80 resistance level on high volume.
After completing that classic bullish ascending triangle pattern.
Plus, back in March, we saw the highly anticipated golden cross. That is when the 50-day moving average crosses above the 200-day.
Historically, for resource stocks, that signal is viewed as confirmation that the long-term trend has shifted upward.
Insider confidence is also sending a clear signal. CEO Greg Kozak purchased 150,000 shares in March.
And the CFO, Sarah Zhang, was right there with him, buying 82,000 shares. It's a tangible show of management putting their own capital on the line.
It's a key signal for the market. However, when we look at the institutional flow, we hit that same contradiction again.
The headline news was very positive, right? Institutional ownership reportedly increased from 58% to 71% in Q1.
With powerhouse funds like Vanguard and BlackRock taking massive new positions, those are the names that provide stability.
They are. But recent scrutiny of flow data shows a different picture since those Q1 filings were reported.
What's it showing?
There has been, well, no detectable institutional buying activity in the most recent weeks.
Yeah.
This suggests the initial wave has stalled out.
So the stock is kind of range-bound because that immediate flow momentum is just absent?
Right. Despite the earlier technical confirmations, the market is holding its breath, waiting for the next verifiable concrete signal.
If the bullish narrative is correct, those signals are right around the corner. Let's look at the upcoming catalysts. First up, an ESG Investor Day on May 14th.
And the market expectation here is high. They are anticipated to unveil an accelerated timeline for Phase 2 of the Manitoba project.
Accelerating Phase 2 is crucial because it ties directly to those 2026 offtake agreement deadlines.
Then, in June, we get the scientific validation. They're scheduled to present their DLE technology demo at the Lithium Industry Conference with third-party data.
If that data confirms the 92% recovery rate, that removes a major piece of technical risk.
And a very specific financial catalyst is coming up on June 24th, when the DOE is scheduled to disperse the $22 million second tranche of their grant.
A continued reminder that this company is seen as a strategic domestic asset.
Now let's pivot to the confirmed, but maybe less exciting, catalyst, the Q2 earnings release on May 22nd.
And consensus estimates suggest only modest sequential improvement over that Q1 miss. So the legacy side is likely to continue its drag.
And we have to dedicate some serious time to the risks because they are significant. Risk number one is execution.
The Phase 2 expansion is incredibly capital intensive. We're talking an estimated $325 million. The completion target is Q4 2026.
The complexity and timing here are very high stakes. Any significant delay beyond that deadline risks triggering penalties or renegotiation clauses in those massive offtake agreements.
The entire bullish valuation is built on these contracts delivering on schedule, and resource projects rarely go off without a hitch.
No, they don't. The financial consequences of a slip could be immediate and severe.
Risk number 2, commodity price volatility. This is particularly relevant given the recent roller coaster in the lithium market.
They do have long-term contracts with a price floor reported to be $12 per kilogram, but that only provides protection, not immunity.
Exactly. The $12 floor protects them from a complete price collapse, but if the spot price drops lower or just hovers near that floor, it drastically challenges their profitability.
Just finally, we have to touch on the M&A chatter, which is where speculation gets extremely heated and potentially geopolitical.
The strategic rumor, and the one that fits well with the IRA focus, suggests a potential minority stake from Albemarle in the Manitoba project.
Which, for Albemarle, would be a smart move to secure long-term, high-quality, domestically sourced DLE lithium.
A very validating rumor. The conflicting rumor, however, comes from Asian market desk chatter. It suggests acquisition interest from a Chinese state-backed metals conglomerate.
And that would introduce severe geopolitical tension immediately. Given the DOE grant money, specifically aimed at securing domestic supply chains.
Any acquisition by a Chinese state entity would complicate, if not potentially terminate, the whole DOE relationship and the IRA subsidies.
That rumor holds far more dramatic potential for volatility.
So we circle back to our starting point. When you are analyzing the metals company, you are forced to make a judgment call.
Are you investing in the high-growth lithium tech player with massive premium offtake agreements? Or are you investing in an industrial metals company struggling with severely compressed margins? The market is currently paralyzed by these two competing realities.
The entire investment thesis rests on the timing of Phase 2 and whether that 10K contradiction is just a legal footnote or a massive red flag. Given the huge DOE grant and the focus on domestic critical minerals, consider this final provocative thought for you. Which acquisition rumor, the strategic interest from Albemarle or the geopolitical interest from the Chinese state conglomerate, would cause the most severe short-term volatility? That tells you where the true sensitivity lies.
Make sure you subscribe to Smart Wealth with Joshua so you never miss our analysis and catalyst talks.